Good morning, everybody. I think in the interest of time and for the benefit of those online as well, who are following us from afar, we would like to start our second day. So as Noelia closed the day, congratulations for being back here, because we had a very long day yesterday. You survived the first day, which was very dense and very insightful in terms of conversations. For those of you who have joined today, I'll do a super brief recap before we delve into the topic of the role of insurance. I'd like also to profusely thank the Bank of Spain for their welcome and their hospitality. It's been amazing. And we learned a key fun fact yesterday that water in the Bank of Spain is being used as a risk protection mechanism because the vaults that sit 35 meters below our feet actually have a capacity to be flooded in case there is a break-in. So for those of you who haven't watched it, apparently Casa de Papel tells you all about this and shows it in practice. So yesterday we talked a lot about water risks, and I think there was broad consensus about the fact that they are material. We then looked at how different central banks are already doing something about it. And we heard a very powerful message from the sub-governor of the Bank of Spain, Soledad Núñez, who effectively said that, you know, for her, the Dana, the catastrophic flooding in the Mediterranean, had been a wake-up call and very instrumental in bringing the attention at the highest level of the institution on water-related risk, which is why we are here today in many ways, because we've been able to organize this meeting here, bringing people from around the world with central banks hailing from Chile, from Georgia, from Morocco, from, of course, Europe, the European Central Bank, which is leading the way on this topic and has been holding the first sort of face-to-face meeting of their water group here just the day before we met. So we heard not only from supervisors, both on banking side and insurance, but also from the Ministry of Environment here, from the public development banks, and from investors. So I think what we're going to move towards today is looking at instruments and the roles of other type of actors, starting with the critical role of insurance, and I'll hand over to my colleague Laila Davis to moderate this panel, and we'll then discuss the critical role of pricing as well of water-related risk. I think one thing that I didn't hear yesterday was the importance of pollution risk, which shows that we still come at it with a framing that is very much inspired by climate discussion, with a strong focus on droughts and floods, and for example, that was not discussed almost in the discussion on fiscal risk, whereas PFAS, for example, can do represent a very substantial investment need, and that may be something you can pick up on, Christopher, at some stage. So I think we hope to make today a lot more interactive than yesterday. After these two sessions, we have a session that will be led by Kate, and I think we can rely on her to wake us up. And so please come at it with ideas about what you would want to go into this roadmap for action, both at national and international level. So keep thinking about that, what needs to be done within a year, within 5 years, etc., and who should do what, because this is the key thing that we want to get out of this meeting. And that will feed into a policy paper and recommendations formulated by the OECD, and potentially to a declaration or some kind of outcome document by central banks or others in the UN process. Let's bear in mind that, you know, at the end of the year, the UN Water Conference is a big moment for water. So what can we take to the UN conference in order to effectively show that, you know, things are happening on the central bank side and what needs to happen next. With that, I'll leave it to Laila. Thank you.
So good morning, everyone, and welcome to session 5. As Sophie said, I'm Laila Davis, policy analyst at the OECD, coordinator on the OECD side for this roundtable, and I was lead author on the report embedding water-related risks in financial stability frameworks, which underpins this, some of the discussions in this meeting. I'm going to take the opportunity of being up here just to really say thank you to Banco de España for the gracious hosting and for being fantastic partners throughout this whole process. Thank you to Juan Carlos, to Noelia, and to Matilde as well for the excellent collaboration, and of course to CDP and NGFS as well. So it's a pleasure to be moderating this morning's conversation on the critical role of insurance. As Sophie mentioned, over the past days, this meeting has been looking at how water-related risks transmit to the financial system through banks, through investors, through sovereign balance sheets. The insurance and reinsurance sectors have a distinctive role. They underwrite the risks directly, seeing loss trends earlier and more granularly than other actors. And increasingly, they're being asked not just to absorb losses, but to also help shape the conditions that determine whether those losses materialize at all. So in our report, actually, we acknowledged insurance as a transmission channel for water-related financial risks, but this session is really an opportunity to explore insurance trends. So where pressure is increasing, where protection gaps may be widening, and to examine the implications for financial stability assessments, which may not be fully capturing some of these dynamics. So in this session, we'll move through the current insurance landscape, and then we'll go towards opportunities for addressing critical insurance challenges. So before I start, 2 quick housekeeping points. The session is being recorded and will be available on the OECD website. In addition, we'll do our best to keep on time and leave you some time for questions at the end of the session. So do start thinking those already. So we have an excellent panel to have this conversation with. I'm delighted to be joined here by Nicolas Jeanmat, Head of Personnel and General Insurance at Insurance Europe. I'd also like to point out that Insurance Europe have developed an excellent position paper as a background note to this meeting, and I invite you to take a look at this. It's linked on our website. We also have Francisco Espejo Gil, Deputy Director of Economic Studies and International Relations from the Consorcio de Compensación de Seguros. So really keen to hear more about Spain's public-private model. And then, of course, we have Esther Bauer, Director of Switzerland and Global Market Development from Swiss Re, with the reinsurer's global view. Thomas Degas, Group Nature Lead at Aviva, an insurer that's been very public about the limits of insurance alone, so very keen to hear your perspectives. And Christopher Gasson, Managing Director of the Global Water Intelligence, and who's just come out of 3 days of the Global Water Summit, which was here in Madrid just 2 days ago, with, I believe, 1,300 participants discussing the theme of accelerating the water transition under capital, climate, and demand pressures. And so this morning, he's going to bring some of the perspectives from that meeting to this discussion through the insurance lens. So let's start. Turning to Nicolas first. Insurance Europe really has visibility across a wide range of European markets in a context where water-related losses are increasing. So from your perspective, what is the sector actually seeing in loss trends, in pricing, in the availability of coverage, and where is the pressure on solvency and underwriting becoming most acute?
Thanks very much, Leila. And also from my side, first of all, a big thank you, muchas gracias to the Bank of Spain for the reception and to the organizers for having me here. It's a very wide question that you asked. I'll try to point to a few facts and maybe a few comments, and then I'm sure that my colleagues on the panel will complement. First, I think it has been mentioned yesterday repeatedly by several speakers. Flood risks is the #1 risk in Europe, and it is a risk that is affecting all parts of Europe, albeit in different ways. And we are seeing that in the figures of economic losses and insured losses. And we are also seeing that there is an increase in severity and frequency of events, and we have a lot of examples that can be referred to. Of course, Valencia, the Our Valley, and affecting also Belgium and Luxembourg and the Netherlands. We had also floods in Central and Eastern Europe, and this winter significant floods in Portugal, Spain, and France. And there is clearly a link with weather changing patterns. For instance, in the case of France, the affected areas saw 40 consecutive days of rain, which is something that Météo France had never recorded since measurements existed. So there is clearly an important element there. We are also seeing that droughts are increasing and affecting increasing parts of Europe, and that is having consequences for economic activities in agriculture, industrial activities, and others. And in terms of risk, there is also a link with a growing risk, which is resilience, a subsidence, sorry, where you see cracks in houses as a result of certain types of soils shrinking and then expanding. So drought is another aspect. I think we will increasingly have to look at the interconnection between risks, especially with severity increasing. For instance, if you take wildfires are a peril in itself, but they can also have in turn an impact on floods, landslides, avalanches, beyond, for instance, human health with air pollution or biodiversity loss. So these interconnections are something being increasingly looked at. Sophie mentioned water pollution. It's something that will not necessarily affect directly property insurers, but is something that liability insurers may increasingly look into, and the extent to which certain risks can be insured and at what conditions with water pollution, for instance, PFAS-related increasing. So these are just a few elements, maybe a few important comments by way of setting the scene. One is that, and you mentioned that in your introduction, in its traditional role, insurers is a risk transfer mechanism, and this role is being played at the end of a chain. We tend to speak of a sort of triple protection approach, where you have first prevention, then intervention, then risk transfer. Prevention is, for instance, related to questions like risk exposure, like value of the assets and where you build, vulnerability, so that would be how you build. Then you have the intervention, so the cost of a damage can have a lot to do with how fast intervention is happening. And then you have, at the end of the chain, if you like, this element of risk transfer. So the point I'm trying to make is that the cost of an event, and therefore the price of insurance, is also very much related to things which are being done on the prevention side and the intervention side, on which a lot of actors have a role to play, and also insurers in their advice capacity. I would like also to mention that, of course, there is a link between the events that we see and climate change, and that's a logical consequence of what I just said. There are other factors that come into play, like where you build, how you build, the value of the assets, urbanization, and also things which have been mentioned yesterday, like hydrology, so nature-based solutions, quality of soils. All of this will, in the end, also have an impact on the severity and the cost of losses. I would also like to stress the important local or national dimension of many of these questions, because you asked about trends in terms of pricing, etc. You can give general trends, but you also need to look into things that are happening in a national context. So, for instance, whether you have a scheme like the consortium in Spain or not, the extent to which a particular country is exposed to certain risks, but also the quality of measures being taken in terms of land use planning, building codes, or intervention. All of these things really are important and have to be taken into account when trying to look at trends in terms of protection gap and these sort of things. And so maybe in terms of, as a summary, clearly there is an increase in frequency and severity of events, which is raising questions in terms of availability of insurance or affordability of insurance for certain risks in certain areas. I would say, globally speaking, that insurance remain available across Europe as a rule. There is a protection gap issue, but it needs to be looked at in detail. What's the source? But in general, I think insurance remains available. And also, I would say that I'm not aware of solvency concerns. So we have a system which is based on very strong, solid prudential rules in Europe. We also have an important distribution of risks, with reinsurers playing an important role as well. So I don't think that that solvency is a particular concern, even with the increase that we are seeing in terms of events.
Okay. Thank you. Some really key points there about different risks, flooding, drought. Grateful for you for having mentioned pollution, which which for us is always a key priority. Also local and global dimensions, both in the risks and the interventions, and this important distinction between focusing on transfer of risk and risk mitigation. So let's go from the market overview to firm level signals. So Aviva is at the intersection as an underwriter, asset owner, and also a vocal public voice on climate adaptation in the UK and beyond. From where you sit, where is the water-related protection gap actually opening? We heard from Nicolas that in Europe it's remaining, there is an issue, but it's remaining relatively strong in terms of insurance coverage. But so where do you see this protection gap opening up fastest from your perspective, and how are the signals you see on the underwriting side starting to feed into the investment side?
Great, thanks very much, Leila. That's a lot of questions, but I'll try and do some justice. First of all, thank you to the Banco de España, I think, for hosting and for yesterday. And I think for those of us that were lucky to go on the tour of the building yesterday, we managed to see a beautiful piece of art by some of the children from Madrid, and made me think of reflecting what we heard yesterday. I think it was quite clear from the speakers. We've gone past the golden age, or rather the Goldilocks age of water, where it's not just right, but we have too little or we have too much. And in the UK, we're exposed to that as acutely as those in the rest of Europe. So I want to focus on flooding and build on what Nicolas said, and particularly provide a UK perspective of what we're seeing, the protection gap, but then also the trends going forward. So in terms of the UK, what we're already seeing is flooding is a growing, not just risk, but is being a realised impact. If you look at annually what the total cost in the UK is of flooding, it's around 6 billion per year, and that's been growing. And as part of that 6 billion, what we're seeing in terms of average insured claims being paid out, those have also risen. So they've been steadily rising. They were up 6% last year, with the average claim around £30,000. Now, those are the kind of big numbers, and what I really want to do is kind of actually explain or pick out how this actually is impacting household balance sheets at the micro level in the UK, because I think that's when we really start to understand the transmission mechanisms, but then also the vulnerabilities that are there. So if you look at the average flooding event in the UK, and if you look at repair damage or costs on average, it's between 30 to 50,000. Now, that's just a number. In perspective, the median median household income in the UK is just north of 30,000. So you're looking at a whole annual income for a household, and thereby needing to dip into savings. Now, also as part of that, when you look at the average property prices, that 30 to 50K is roughly about 10 to 20% of a home value, and that's today. That's not in the future. That's not how physical risks are impacting. That's the impacts we're seeing today. And of those events in severity, when houses are flooded, people or homes are displaced for between 9 to 12 months. So this isn't just an event happens, people move out, that affects their employment, that affects in terms of our economy, human capital, and the ability to get back to work. So there is a persistent shock that households face. Now, when a flood happens, obviously it doesn't just hit homes, it hits other physical assets for households, and particularly vehicles, so also a motor insurer. And also if you look at what's happening to motor insurance in the past few years, most recently, more than half of motor insured claims had to be fully written off because of the extent of the damage. So homes are being hit, other assets such as cars are being hit. And so really what you're seeing is multiple shocks to household balance sheets and persistent shocks that only impact over time, as that can also impact employment and their availability to work. So what does that mean in terms of a protection gap space? And that's what you asked. For those, and apologies, I might just be saying what people know of what the protection gap is, but the protection gap can be thought of the economic losses that occur, how much is currently insured, so how much could you claim back. If you look at the UK, it's around 30%, so what that means is the bulk is still insured, 70%. But crucially, that number, the gap has grown. So about a decade ago, it was around 20%, and that's grown to about 30%. Now, again, that's an absolute figure. In relative terms, and particularly in Europe, the protection gap is around 30%. You probably have lower in certain economies, such as Japan, but higher in terms of Canada and the US, where the protection gap's already higher. Now, in the UK, that level of around 30% can be explained in terms of relatively still low, I would say, by two things. One is the UK is quite a mature insurance market. There's a huge amount of market penetration. We as Aviva, in the UK, 1 in 4 people have a Aviva product, so you can proxy that for how many people actually have insurance in the UK. The second, which I think we'll come back to in the next round of questions, is also the existence in the UK of Flood Re, which is a reinsurance program, which is a public-private partnership to help those already in high-risk zones of flooding, make sure that flooding insurance is more affordable. So thereby that also helps mitigate a growing gap. But lastly, in terms of the direction of travel, I want to make a critical point about what would drive a growing protection gap over time. And I want to make a point about exposure of existing stock, particularly houses, but then also new builds. Where are we building new homes that could be exposed? So in the UK, as it stands, right as of today, around 6 million homes are at risk of flooding. Now, it's expected, if you look at the Environment Agency or government estimates, that would rise to about 8 million on central estimates by 2050. And that's of current housing stock. So if we do nothing, if we build no new houses, or if we build them where they are, the risk will rise. But what we've also seen in the past 5 years, 5 to 10 years, is where we're building houses still in places that either today currently at risk of flooding or will be. So in the past 3 years, 1 in 9 new homes in the UK have been built in an area that's either moderately to highly exposed to flood risk today. And if you look at 2024 alone, so 2 years ago, a third of new homes were built in places where by 2050 we're expecting to be extremely prone to flooding. So the protection gap can build based on where we're building houses, but also where houses currently lie. And I think that's the element of which I'll close on, which is it's not just necessarily the biophysical trends or what we will see. It is about how are we actually building our economies, which will leave us exposed if we're not putting in resilience measures.
It's a really interesting point. So there are signals that are coming from the underwriting side, but they're not actually being priced on the investment side, particularly here in the case of flooding and buildings. So we'll come back to a few of the points you made, particularly on the public-private models. But first, I wanted to turn to Esther. As reinsurers have a uniquely long and global view of water-related loss trends. So from Swiss Re's view, how are these trends shifting from your perspective, and what does it mean for how primary insurers, governments, and the public sector should be thinking about water-related risks in the years ahead?
Thank you very much, Laila, and equally thank you very much to Banco de España for having us here. Yes, I'll be giving a global perspective. I would like to touch briefly on the protection gap, the loss trends, and the importance of prevention and adaptation. Globally, natural catastrophe cost 220 billion losses worldwide in 2022. Of those, almost 50% were covered by insurance. That was a record high. It's still only 50%, but I think it's also a bit of a positive message today when we talk about the protection gap. And we have already heard it is more typically higher. The insurance penetration is typically higher in countries that have some form of national scheme, be it public-private or not, but France, Spain, Switzerland, UK, these numbers, what is insured is higher, but we still have many countries, even in Europe, where it is much lower, especially central, eastern, and southeastern parts of Europe, where often even less than 20% are insured. And I'm not even talking about Asia, which is also highly exposed to flood risk, where also typically less than 20% are covered by insurance. But more can be done. So it's not only that insurance becomes difficult in places, but it is also more that can be done around the world. I find it important to note that until about 30 to 40 years ago, flood has been widely considered as very difficult or even uninsurable by the private insurance industry. I remember when we published a report in the late 90s called Floods Are Insurable. And it caused a lot of debates with our clients, but since then, a lot more risk have been insured, and thanks to advances in probabilistic modeling, computing power, data analytics, the industry has become better and more comfortable in assessing the risk and providing cover. Yes, there are areas where it's more difficult, and it's becoming mainly in an affordability challenge. But as I say, in many countries, more could be done to stimulate the demand. Actually, it's not so much a problem that there isn't sufficient supply, but people and businesses are often not aware of the risk, think it's not going to hit them in the foreseeable future, or rely that the state would chip in. And we have seen changes in law in the last 2 years in Italy and Greece, where it has become mandatory for all businesses to insure against a certain set of natural catastrophes, and Portugal has just recently announced to also introduce such a scheme. It has been said losses are increasing. We see an increase of around 5 to 7% annually in real terms in terms of insured losses. What we call secondary perils, which is an ugly term, it's not, the insurance industry started to model first earthquake and storm risks, and so all the others that have come later into the modeling landscape were considered secondary perils. But what we really mean is floods, severe convective storm, wildfires are now the fastest growing segments of insured losses. But also important to note, more than 80% of the global increase in weather-related insurance losses is driven by exposure growth. And what we mean that is more people, assets, and infrastructure are concentrated in heavily exposed areas. So soil sealing, insufficient drainage systems, and rapid urban expansion are amplifying runoff and loss severity. So that's why the topic has been mentioned of prevention and adaptation becomes so important, and we see clear evidence that it works. Again, in countries like Switzerland, but also UK, France, flood losses have been materially constrained with respective investment through flood defenses, better water management, and stronger prevention measures. Research shows, this is interesting, that adaptation has reduced European flood economic losses by around 63% since 1950, largely offsetting the increased flood risk from hazard shift and floodplain expansion. So the question is really, are we keeping up with those investments, where we have seen big benefits? We have, a while ago, acquired our own a flood modeling company called Fathom. They estimate that UK household flood losses would be about 2.8 times higher without existing flood protection. So the message is water risk is rising, but there are also ways to deal with it, both on the investment, prevention, adaptation side, but also doing more on the insurance side. The regions that invest in flood protection, drainage, land use planning, and better water management are seeing the benefits. And clearly we have seen that also in the floods in Central and Eastern Europe, Storm Boris, where losses were lower than would have expected 10, 20 years ago with the measures that have been introduced. I'll get back on a few other points later.
Thank you. So some positive messages there about the insurance sector becoming more comfortable with flood risk, and also the need and I guess the scope then for increasing the demand side. But the 220 billion figure, it's interesting because 50% is positive in the fact that's increasing, but that's still of course 110 billion that's not covered, which is quite striking. And particularly with secondary perils increasing, including flooding, and as you mentioned, increasing economic value in exposed areas. And I do like your point on well-designed adaptation measures that can that have a return on investment and that are critical infrastructure. So a question perhaps that we can come back to afterwards is, so what insurers are playing in this role upstream, as well, what role they're playing, and also who's coordinating between insurers, government, private sector to work there, to make this change happen. But before we go back to that, a fundamental issue is how to make sure that this remains a shared responsibility while these risks are materializing, and that insurers are remaining engaged in risk transfer while adaptation measures are scaling in parallel. So with that, I'll turn to Francisco. So the Consorcio de Compensación de Seguros is one of the most developed public-private insurance schemes for catastrophic risks, including, of course, water-related disasters. So how does the Spanish model handle water-related risks in practice? Can you tell us about the design choices that have held up under pressure and the ones that are being tested as water-related losses are increasing?
Well, good morning, thank you. Thank you for your question. And I join my previous speakers previous colleagues in thanking Banco de España for their invitation and for generous hosting of this meeting. Indeed, Spain has, and we were referenced many times yesterday afternoon, we have quite different approach or a bold approach to the mutualizing of certain risks. Obviously, the system wasn't thought thinking about climate change or climate change adaptation because it was founded in 1954, but the principle is valid and still is in use, which is to mutualize a list of extraordinary perils that must be covered in every insurance policy. In most property policies, in all personal injury policies, and in all business interruption policies. That means that if you insure this building or your home in Spain, you have to have a list of perils covered: flood, windstorm, earthquake, volcanic eruption, tsunami, and also human-made perils such as terrorist attacks, civil commotion, etc. So we make a pool of different uncorrelated perils, and we finance this scheme by applying a surcharge to all those policies, which in total today are 144 million across the country. It means that we are mutualizing all these risks between every property, and Spain is a very varied country from a climatological point of view. We have 13 different climates only in the Iberian Peninsula. So we have different areas which we can compensate one climates with the others. And we have we apply a flat rate because some parts can be more prone to be affected by a flood, whereas some others can be more affected by an earthquake or by a windstorm or by a terrorist attack. Therefore, the premium is flat for everybody, and it's quite cheap in general. So it's, for instance, a typical household in Spain is paying a surcharge between 50 and 20 euros per year. And that's all. But we are covering 21 million residential properties. Therefore, we have, if in Spain 80% of the homes have insurance, and insurance is a voluntary thing, 80% of the residential households, of the residential properties, have flood insurance. And that is a very powerful tool to cope with adverse selection, which is a problem in which, if in some countries, those who are more prone to be affected by a given peril have to pay more premiums, and that potentially can drive market failures or unaffordability issues. For instance, in Australia, 15% of the homes are paying more than a month's wage income per year. for their insurance premiums. Therefore, there is an issue by means of which those that need protection the most, and I think that we all agree that insurance is a very good tool to provide, for starters, economical resilience, and in a second step, physical resilience through many ways, premiums, deductibles, investments, etc. Our scheme is, I believe, good in trying to eliminate this adverse selection and try to provide a universal cover for everybody. Indeed, in October 2024, our system was tested by the hardest test possible, which was actually we had our PML in Valencia, this is the like Esther just said, it is the combination of a very large exposure. Valencia is the third city in the country. In the metropolitan area of Valencia, 2 million people are living, and in the area affected, about 200,000 people living, with a lot of industrial compounds, logistical infrastructure, etc. And it was very much hit by a very intense precipitation, which is not at all abnormal in the Mediterranean, but it's becoming worse. Mediterranean is becoming a weather bomb. It has always been so, because by the end of the summer, the sea surface temperature is about 20, or used to be about 26, 27 degrees, and now it's reaching almost 30 degrees. So that's adding more moisture to the atmosphere, and that is exacerbating the already existing problem of very intense precipitation when the first depressions at the end of the summer and the beginning of the autumn are starting to pass through our latitude. So this combination of effects was the trigger of about 5 billion loss for us, of a very sad loss of life as well. And well, our system, we believe that it provided a good answer. About 6-7 months after the catastrophe, we reached the 80% of the claims paid, thanks also to this public-private partnership that we have in Spain. So we had in like 10 days, we reached an agreement with private companies so that they could help us assess the loss and file the claims. Normally, when there is a property affected by one of consortium's perils, it is us directly filing the claim, assessing the loss, etc., and we pay the loss directly to the policyholder. That's why we are a direct insurer, unlike our philosophical cousins, which are our friends' neighbors, in which this public-private partnership is implemented through our reinsurance company. We are a direct insurer. But in this case, the number of claims was so high. We are talking about 250,000 claims in one afternoon, and we had to call in the companies who voluntarily accepted the challenge, and they handled and assessed half of the claims, roughly. Within speaking, you spoke about cars, for instance. In Valencia, 144,000 cars were affected. There are 40 countries in the world that have less cars than the ones that got affected in Valencia. So yeah, the size of the impact is terrible, or was terrible. But I think that we kind of passed the test, and obviously, we have created a lot of information that we are willing to put in the hands about very granular and about how and where the affection was produced, not only in Valencia, along our history, and we share this information with all those administrations and agencies that have to deal with with a peril, so that I think that we can continue making this virtuous circle grow of providing an answer first, because if insurance cannot step in because of premium prices or affordability issues, insurance stops being relevant. And I think that the challenge here is to keep insurance being relevant in many ways, and one of them is, for starters, adding response capacity to society by indemnifying economic losses, but also providing information on the physical damage so that others can jump in and do something in terms of land regulation, building codes, etc.
Thank you. Some really, really interesting points there. I just wanted to go back to the design, really, on focusing on availability and affordability in the program itself. And so through compulsory coverage to prevent adverse selection and national mutualization by binding these uncorrelated hazards. So, so just on the design structure itself, and the fact that you have this experience of the Valencia floods, which I think most people are aware of, and that it actually stood up to the test of it, and there are some important lessons that have been generated for the program. So let's move to Christopher. We'll come back to everyone in the second round of questions. But so Christopher, you have the unique perspective on the panel from the GWI and really having this overview of the water sector as a whole. So from what you've heard from the panel so far, what would you want to tell insurers about where water-related risks are concentrating, how the sector is reacting, and what the insurance sector actually might not be aware of or should be preparing for?
So give you a bit of a backstory about how we've approached this as an issue. So 2 years ago, we did a piece of research looking at the MNET data about trying to quantify what proportion of the cost of climate change would fall on the water cycle, i.e. looking at water-related risks related to climate change and what proportion of the total sort of climate-related insurance payouts there might be. And we found that it was something like 69% of the sort of impacts of climate change were in the water cycle from an insurance point of view. And we could see that it was growing quite quickly. So last year we did some research with NASA looking at the correlation between extreme weather events, i.e., I mean, the way that they measured it is sort of floods and droughts which are greater than one standard deviation from the mean, and how that had changed with the rising temperatures. And there's quite a sort of alarming correlation, as one can imagine, that, as temperatures have risen, we've seen this extraordinary kurtosis of the water cycle, i.e., it used to be more like that, and now it's more, the extreme events are more extreme or more intense, and the sort of mean, it becomes less frequent. So that's the sort of trend that we're seeing. And last year was actually a relatively cool year compared to the year before because of the La Nina. But if we are moving on to El Nino in the late half of this year and into next year, I think we'll get back on that very strong trajectory of this kurtosis within the water cycle, which is going to have a huge impact on the way that sort of, I guess, insurers think about these things. But we also did a piece of research this year looking at the sort of relationship with sort of water and the new economy. Here it's sort of, obviously that sort of AI story with, data centers and semiconductor fabs and so forth, and how they're interacting with water. And I think one interesting thing to look at is, when you look at the impact of the war on the energy sector, it's been quite delayed. You've had this something which is a sort of what one would think is a quite catastrophic event of having a decent percentage of the energy taken out of the sector. But because you've got long supply chains, large inventories, the nature of this old physical economy actually has got a lot of ability to absorb risk in it, which doesn't exist in the AI economy. You know, if you have an outage, you know, in a semiconductor fab, it can cost, you know, like just in terms of lost production, you can lose like $400 million in a day as a result of your water not being there. And, you know, similarly, you know, with some of these data centers, the losses can come quite immediately. You know, if you've got you know, one of these big hyperscale data centers and you don't have water on that hot day in summer when you're sort of needing to have it, you can fry $1 billion worth of chips like that. You know, it's sort of serious sort of economic risk. And what one's feeling is that the global economy is moving towards this always-on, 24/7, you know, short supply chains, no inventory, nobody working in shifts, you know, which is much more exposed to these environmental shocks than a more traditional economy like the sort of energy that we've seen. So, I mean, the theme of our conference this year was you know, something like delivering the water transition. We know we need to have a transition in the way that we manage water in the same way that we have had in the way that we manage energy. And, you know, I mean, Sophie very kindly came up at on the opening panel to you know, talk about this event and this question of, you know, how much of a risk to the financial system these things that we've been observing are. And we asked the audience, what do they think? We gave them 3 options. You know, the first option was it's an immediate risk, but a regional one. The second option was that it's not an immediate risk, but it is definitely one in the long term. And I guess that the people who voted for the third risk basically took the view that this meeting was you know, therapy for Europeans who didn't want to talk about the real risk in the financial sector, and i.e. water wasn't a risk at all. The top, I can't remember, some like more than 50% said that they thought that this was a longer term risk rather than something which is immediate, but probably about a third thought that it was immediate but on a regional basis. And I think that this regional thing is interesting because, you know, when I've talked to people about it, it's not the, you know, the risk itself that they think will knock over the financial system. It's the way it interacts with other risks which are happening at the same time. So, for example, at the moment, the sort of big anxiety in the water sector is around Corpus Christi, which is, I think, the biggest, or second biggest LNG export center in the US. And, you know, they're going to run out of water unless the sort of rains arrive by November. And, you know, if you have that LNG port getting knocked out at the same time as, you know, Europe and other parts of the world really needing a lot of LNG from the US as opposed to the Gulf, you know, you start getting these sort of accumulated risks. So we also had a bit of discussion of, you know, who was going to be paying for this water transition we wanted. And we put it out to the audience to ask, you know, who they thought. And it was interesting that the insurers were sort of pretty much off the hook. I think that only 5% of people in the room felt that the insurers were the people who needed to be thinking about investing to reduce these risks. And, you know, I find it quite interesting here that a lot of the way that the insurance industry seems to be thinking about this is, you know, yippee, this is an opportunity, we've got a captive market, they've got to insure, and we can start pushing up the premiums to cover ourselves. Because insurers are very good at dealing with risk. And, you know, you can see that that this could be a good opportunity to build things out. But I'm not hearing this discussion of, you know, how are we as the insurance industry going to use the funds that we invest to reduce those risks overall. And I think one of the things which I feel is that there needs to be a sort of reallocation of capital, that currently probably less than 1% of global assets under management are allocated to water-related investments, and that we probably need, if we're going to get through this water transition, to have that more like sort of 5% of assets allocated to water-related investment. And I would have thought that the insurers should be the people who are leading the way.
Thank you. A number of really interesting points there, and I think I'll give the panel a chance to react in the next questions. So I'm determined to give some time for questions at the end of the session. So I'm going to go into the next questions, but let's try and maybe. I'm sorry, my questions are also very big, which is an issue. But so we'll try and do the 2-minute answer on these ones. So I'm going to start off with Nicolas, going back to you again. Yeah. And I think looking ahead, because in this part I really want to focus on what next. So, what policy and regulatory changes really do you see that are needed that sit beyond the industry's own control, and what can the industry do differently? Those two parts of the question. And actually, given that we're in this room and there are supervisors here and government as well, what would you want them to keep in mind as well and to know? Okay.
Yeah, thanks very much. I think in terms of maybe the second part on what the industry can do differently, I think what we are seeing really currently is an increased focus on prevention. So, and I think this is not new. Prevention is really a core part of the insurance business model, but in a way you could argue that with risks becoming more severe, more frequent, it's not a nice to have anymore. It's something that has to be scaled up very significantly. And we see a lot of initiatives where insurance companies are advising on how to reduce risks very concretely, going to buildings and saying this or that has to change for the risk affecting that building to be reduced, etc. We see initiatives also, for instance, in France, in terms of there are tests being made on how buildings exposed to subsidence risks could be retrofitted in order to reduce the risk affecting those buildings. We have listed, in fact, a number of those initiatives in which the insurance sector is involved in the booklet in the position paper that you mentioned. And I think this is something that's happening now at a larger scale than used to be the case maybe a couple of years ago, and probably this is a trend also because of new, as I mentioned, there are also possibility to use new technologies, AI or digital tools in order to spot leaks or to spot a wildfire as soon as it is happening. So I think we need to make use of these tools in the right way in order to increase prevention, therefore reduce exposure to risks. In terms of but again, I would really stress the point that the insurance sector is part of a bigger chain, bigger picture, and so there will be a need to increase partnerships with authorities, supervisory authorities, local authorities, national authorities, in terms of how altogether measures can be defined and taken in order to reduce basically the risk exposure and the vulnerabilities in order for, to quote PACO, for insurance to remain relevant. And then there is probably also an element of investment, certainly, but here I would say that, of course, the money that insurers can invest is in the end the money of policyholders, and there is a need for the money, for an investment to be an investment, so it has to meet certain conditions, such as generating a return. Otherwise, it's not considered an investment, and it would not be prudent for the insurance company to just allocate the money just to reduce future losses. So there is a need. I think it is very important. The insurance sector can play a role in financing some of that transition, but the model needs to be defined, and there is a need for that to happen in a way which also avoids free riding and that sort of things. I mean, it's a complex question, an important one, and certainly one that could be discussed during a panel. And maybe a message to the supervisory committee, regulatory committees would be probably it's really good to have this discussion. We should look at it from the different aspects, and we should probably not rush into conclusions that, for instance, the regulatory framework needs to be adapted. Again, we have a sophisticated regulatory framework, which I think is fit for also future risks. Doesn't mean it shouldn't be amended here or there, but I think we should build on what we have and look concretely whether we have the right tools in place, which for me is largely the case from that point of view, and we need to be careful before changing what we have, which works well. Yeah, that would be my points.
Thank you. Over to Esther. How can reinsurers, governments and investors work together to ensure that growing water-related risks remain insurable and affordable?
Yeah, $1 million question or euro question. We have to work more closely together. The how is, that's why we need these discussion rounds and forum to talk to, those outside industry and policymakers, regulator, etc. I think it's important to recognize that insurance is, an important mechanism to compensate after loss has occurred. The first priority must be reducing the risk as much as possible to keep insurance affordable. But the important other aspect is that insurance puts a price tag on risk. And that is an important signal for the entire economy, for all the different players in the market. And that price signal also needs to be taken into consideration by all market participants in the economy. And that also means we need to invest in risk intelligence and continue to invest in assessing the risk. Looking at past historic data is not enough. We need to look into the future, invest into modeling, improving the data, because a lot of these events are so localized that we need to improve to really have informed decision-making. And then this information can also be used to inform prevention and adaptation measures to calculate the best benefit cost ratios, what is worth investing, what gives the biggest return in terms of losses that can be avoided. And we have done some analysis, and these benefit to cost ratios range from 2 to 1 to more than 10 to 1. So for every dollar spent or every euro spent, $2 or $10 can be avoided in terms of future losses. Or even more. There are examples out there with fantastic ratios. So and we also we make our models increasingly available to other partners, large corporates that have factories around the world. Banks are increasingly using our tools to assess the exposure of their mortgage portfolios. We employ more than 60 scientists and run 200 models globally, so we are very committed to engage more actively. Such that, resilience must become a core economic and investment priority. And then also the discussion about public-private partnerships in terms of how we can increase the insurance penetration in the different countries, such that these residual risks are being insured. And again, we see still in many countries, a lot needs to be invested to make people aware and to create incentives or even some form of obligation that households and businesses are being insured, such that these losses are not ending up on public budgets. There's also quite some innovation going on in the insurance industry, and we are very active in that, in developing alternative forms of insurance, so-called parametric insurance, that make payouts based on physical parameters, amount of rainfall in a certain location, extent of flooding in certain areas. And these instruments are particularly suited to cover losses that traditional insurance does not cover. Emergency intervention costs, public infrastructure that is very difficult to insure on a traditional basis. There are also such new instruments. We are very happy to engage. So I would say, to summarize, flood losses are highly responsive to adaptation if governments, insurers, infrastructure planners, and investors act early and collectively. We can materially reduce future losses, narrow protection gap, and preserve long-term insurability. To your point, if we reduce future losses, that also has an impact on the prices. And we also see really positive impacts. Australia, there are several examples where, thanks to big investments, premium rates came down 30%, 35%. In Switzerland, the charge for natural catastrophe by private insurers, those, we have a complex system, but in the private system, over the past 20 years, the premium rate for natural catastrophe has been reduced by 30%. So I'm just saying this pays off, this investment.
Thank you. So maybe jumping to Francisco, and maybe we'll just focus on one point here. But this is obviously a very successful model in Spain, and I think there's important lessons for other countries in this. So maybe one key point is, so I think maybe just what are the key points that you would want the international community to know about this scheme and how it can be replicated, and the specific, what they should keep in mind?
Yeah. Well, we never try to proselytize our model. We were very well aware that this is a model that works in Spain, that was developed in Spain for the, it's like the railway tracks. They develop with the history and with the geography of a country, and it's very difficult to replicate the Spanish railway system in Congo. And it's different, the conditions are different, and the historical evolution of it is different. Therefore, we having absolutely no interest in selling anything or in preaching any new reality or whatever. It's true that we have some ideas that when we are asked, we share. For starters, the main point is that we are not here to represent any hindrance to the market or to eliminate market opportunities for insurers or reinsurers. I think that we all have a space, and I think that when you have a broader insurable mass, you have a bigger insurance penetration, you have more business for everybody, including international reinsurers. Therefore, we are not there to hinder market. We are to foster market, actually, and to make markets work better. Taking into account that it is not our priority, the insurance companies. Our priority is the people, the insured. So that's something that we always have in mind. And it's also an important point that to maintain moral hazard at bay, we are sharing risks with the market. Not all water risks in Spain are covered by us. We cover flood, but all the direct effects of precipitation, hail, which is an important risk, leaking from the roofs, snow, all those are directly covered by the market, and they reinsure, and they have a capacity that we don't, which is subscription. So they can control moral hazard by having skin in the game. It is important that every actor keeps skin in the game. Therefore, you don't externalize your losses to a third party. So that's not the idea. The idea is to complement and to make the system work better. And we also give policyholders skin in the game. We apply deductibles for industrial and commercial properties, not for domestic economy, but we do those that represent larger losses, which are industries and large commercial shops, etc. they have to pay a 7% deductible. Therefore, I think that the idea is to develop a win-win situation adapted to any country, not all perils. For instance, in Portugal, wildfire is a relevant risk. We are not covering wildfire in Spain because it's not material from the insurance perspective. In Portugal, it is. So it might make sense to design a system in which all those hazards that are affecting more the people are bounded into this kind of compulsory extension if they want to try to replicate some ideas such as ours.
Thank you. Moving to Thomas. So what does it actually take for an insurer to move upstream from risk transfer into actually shaping risk itself? And where are the institutional and regulatory barriers that even a willing insurer runs into that need to be addressed?
Great, thanks. I know we're conscious of time, so I just want to give some really practical examples of what we're doing that plays to some of the stuff that's been said. I mean, I'll just start by the point that's already been made about what we can do is price, manage, and transfer risk. What insurers can't do is absorb systemic risk indefinitely, period. What I also want to give the examples is, I'm not going to, also into a spirit of time, but can talk about it afterwards, is what we're doing is in the round of, as you mentioned, we're an asset owner. We have investments in sustainable assets that include infrastructure. We have ambitions, interim ambitions we've met, but we've set this out in our second iteration of our transition plan, which sets out how we have a balanced or increasingly balanced focus between mitigation, which is the best form of prevention in terms of net zero, but then also adaptation as well. But to give four tangible examples, and I'll try if I can, although it might not be a strong link to relevance for central banks and supervisors. The first is what we can do in terms of our insurance and our claims in the event an event happens. And I think both of these examples, I think, have behavioral elements that will be interesting for a central bank or a supervisor to see, recognize, and particularly the impacts on household balance sheets. So the first is if an event occurs. If a flooding event occurs, one of the things we can do, and we are doing increasingly through a Build Back Better scheme, is we can offer through our claims processes suggestions, claims, associated payouts, money to households about supporting resilience measures that they can put in place in their homes so that next time the impact or severity would be less. Now, crucially, the ability of that uptake depends on the behavior of the household. If the household wants that, they can take it. If it doesn't, they don't. So I think what we've seen globally, or what you can see globally, is actually for measures like that, and again, it's not immune to the UK, there's actually relatively low uptake from consumers for that. And that can be, in part, explained, as I mentioned, if you are displaced for 9 to 12 months, your priority is getting back to normal. You necessarily won't think in the very immediate term of planning resilience beyond, but I think that's a broader behavioral question. The second is, what can we do before an event? Now, we obviously live in an age where there's a huge amount of information, there's lots of reports, there's lots of news articles, but what we can do now, through the beauty of everyone in this room has an iPhone, or any other phone, sorry, I'm not just plugging Apple, is you have apps, and apps can give you information before an event. So one of the things we've recently released and pushed out, particularly to customers that are in high-risk flood areas, is an app that will tell you, give you an alert when a flood is expected to happen, and that obviously draws on data that we know and we all collectively know. It gives them information on what they can do to prevent the severity of impact, and if possible, gives them a personalized plan of what they could do from a broader set of prevention. So that's using technology of this age, not past age, this age, to give high-risk customers the information they need when they need it in the most accessible form. So again, we'll see how that plays out and how it is used and what the impact, but again, I think about providing customers with means of information in a way that we would use it today is paramount. Now, those are things that from an individual point. We've talked about systems yesterday, and you talked about, and we've heard it on the panel, 2 tangible things we can do from a systems perspective, or are doing rather. The first is being very clear, as you probably saw from my first answer, that ultimately this is a real economy policy issue. But what we can do is we can lean in and be very specific on that, and what do we mean in terms of things that we think could help mitigate risks that obviously are sourced in the real economy. So one of the things we have done through our Building Futures community work, which we published, is set up very transparently 6 areas of policy asks, covering, and I won't cover all of them because they're public, but covering about planning, planning approvals and planning in high-risk or expected high-risk flood zones, the ability of homes to have sustainable urban drainage systems, and that obviously affects town and city planning. And third, which I want to build on, is scaling up natural flood management, because we know natural flood management has a huge number of benefits if done well, but at the moment isn't kind of scaled in terms of the amount of public, even public, but private funding that goes into it. Now, it's all well and good for us to say, let's scale it up, and then leave it at there. But we know that when it comes particularly to natural flood management, and you're looking at the benefits, which ultimately are adaptation-related benefits, there isn't an obvious revenue stream. You know, who will pay for the benefits of increased adaptational resilience? Highly local, highly contextual, depends on where you are, particularly in terms of a water catchment if you're upstream. So one of the things we are doing that was launched last year was we chair a new coalition in the UK that's called Flood Action. This coalition has insurers, banks, landowners, NGOs, involvement of government agencies with a clear ambition to actually build and scale a water resilient market in the UK. So we're supporting natural flood management or nature-based projects in the UK and actually crowding in private institutional capital. Now, that takes time. One of the things that we are doing, or increasingly doing, is first you need to identify the project pipeline. So when it comes to something like natural flood management, in some sense it's quite easy because we know where the catchments are in the UK. We know, we can understand the beneficiaries around that. And so working with those stakeholders I mentioned, you can really start to paint a very clear picture of where you'd have scalable, sizable projects in terms of natural flood management. The second bit is the financial mechanism, and that's looking at the beneficiaries of, if there was investment in a certain catchment, who ultimately would benefit in that surrounding area. And so from doing that, we're exploring the development of catchment companies in terms of kind of financial models or financial instruments, and that can actually work into start getting revenue into these projects and actually commercially scale. So again, it's working with others to actually scale investments into an asset class that does not exist, but needs to exist if we actually want to support adaptation and resilience at scale.
Brilliant. A lot of really interesting points there. So I wanted to briefly hand over to Christopher to react to what the panel has just said and actually ask them a question. I know we don't have a lot of time. I might call back 5 minutes because we lost it at the start. So one question from you, and then we'll try and take at least one question from the audience.
Well, I guess my observation is that, you know, the insurance industry, including the reinsurance industry, ensures, you know, covers a lot of the risk, but ultimately it's governments who mop up most of this systemic risk associated with this. And, you know, we've got to this situation, and this is where I think, you know, central banks and others have to be interested, where the, you know, public balance sheets are both overstretched. You know, governments have got huge deficits all over the world, and they can't invest more money in mitigating their risks. And they're also overexposed to those risks. And so you have that sort of nice, well, terrifying sort of correlation between overexposure and overstretched, which one feels is going to get worse unless we see more private capital sort of getting involved in addressing those risks. And as I see it, there's sort of two sides to this. I mean, a few years back, I was involved with the Global Agenda Council on Water for the World Economic Forum, and we thought, hey, you know, maybe there's an income stream from which will make these things fundable if we can have infrastructure investment for reduced in exchange for reduced insurance premiums. And we went to speak to the Insurance Global Agenda Council, and they told us to go away because they'd have their black boxes, and they didn't want to open up their black boxes to explain their risk models, which would be necessary in order to do that. But I think more generally, there is this question of, you know, that's what the insurance companies could do for to make it a little bit easier to attract private capital into this. But I think they're also, to this point that, what I think you were sort of implying, Nicholas, that water's a bloody awful investment, so what the hell? Actually, it can be a great investment, but it actually needs, more engagement, with governments to say, hey, we can help you with this, because at the moment it is, all of this infrastructure stuff is very much on the public balance sheet. And, creating those models which make it investable and make it into an attractive investment is great. It is something which, if you can invest in long-term water infrastructure, it has relatively low sort of variability. I mean, it is a halo asset, whatever it is. Heavy assets, light, what's the O stand for? I can't remember. Obsolescence. Water's never going to be obsolete, so it is a good thing. So I guess my challenge to the insurance sector is, can you engage with this, on the capital side, to address this this risk, which is, as you say, systemic and growing?
Who would like to react?
I can keep it brief. Obviously, hopefully I've displayed we are engaged. Hopefully, we want to do it in collaboration. All our things are in collaboration, but always happy to collaborate more on something.
Agreeing with Nicola has been saying before, infrastructure and including water infrastructure, this needs to become a clear asset class with clear revenue streams, and then insurers also can invest more easily in that. We are part of an overall effort that was created through the Insurance Development Forum to create an infrastructure investment fund where insurers are participating, including us. So there is progress, but there is also more need to make this an investable asset class.
Mm-hmm. But in our case, being a state-owned company, being a public company, puts us in a very good position to talk to the government in terms of sitting in, for instance, the national flood directive implementation table and speak to, as I said several times, to speak to those agencies that have the competencies to manage risks. So it's we are in an interesting position to talk to the private markets and to talk to the government and to the agencies. And I think that's another good point of where we are here in Spain.
And I would say that the objective of increasing insurance penetration is, of course, a valuable one. I think Esther mentioned before that the proportion of losses that are covered are at a historical high, and I think this is the objective in order to share in the end the burden of losses. And there are various ways to achieve that, which I think we have explored, one of which is really to do more in prevention, but also have a more of a risk culture where ownership of the risk is being taken by a range of stakeholders, including policyholders. I think this will be important to acknowledge that there is an element of the responsibility which falls on policyholders, whether they are individuals, of course, to the extent that they can do it, and there can be support for that, but I think there will be a need to take more ownership of risks, also companies and public authorities. And I also agree that the assets are important, and there is a need to look at the investment capacity of different players, including insurers. I think it's really a range of ways that need to be explored very seriously in order to address the concern that you have expressed of the fiscal burden and that is growing.
Okay, I'm going to take one question from the audience, and everyone has a 30-second answer to it. I'm sorry. So I see multiple hands. I am going to go for... sorry about this. Kate, as you have the session afterwards, I'm sorry, I'm not going to give it to you. We'll go here. There you go. Please, the gentleman on the side here. No, that's you, yes.
Works? Yeah. Hi, my name is Marcio Viegas, my cousin there. Founder of Sustain, and also I'm an independent researcher. Well, first a just a reflection, don't need to answer on this, but I think that a critical role for insurance is not to provide insurance, for instance, to the fossil fuel sector. But you don't need to answer this, but let me talk about two pieces of research we published. Last year, for instance, we did research on the role of insurance and how to reduce and prevent risks. And when we made a few recommendations, and some of them are popping out here today. For instance, the Build Back Better, which is something that I would like to hear from you. What are your thoughts? And also things like parametric insurance mentioned by Esther, for instance. What are your views on parametric insurance? But also, when insurance is too good, you may have a moral hazard. So how to deal with that in nowadays? And we did another piece of research 2 years ago on the role of insurance as the insurance sector as institutional investors. And one of the key or innovations was these catastrophic bonds. And maybe from my cousin, from Thomas, and many views on how you're investing or you're issuing catastrophic bonds, but also maybe from Swiss RE, your views on cat bonds, please. Thank you.
Okay. Brief answers. Maybe we can start with Nikolai if you'd like.
In 30 seconds, it would be, we need
Sorry.
another panel.
Maybe you just answer one part of the question then, and we'll share it across.
I mean, all very good points, certainly, and I think all of it is part of a toolbox, really. Parametric insurance, cat bonds, everything that can increase capacity is important, and also we need absolutely to avoid moral hazard, so there is a need to have systems which are increasing the coverage in a way, but also make room for price signal. That's very important.
About moral hazard, well, you know, we've spoken many times about this short blanket problem in which you have to decide if you address adverse selection or you address moral hazard. In our case, we address adverse selection. That this is a very theoretical issue in terms that we are there to provide a solution for people. Barcelona, Valencia, Malaga, Paris, London, New York are floodable areas. What do? We don't provide insurance in London or in Paris or in. So we have to come with a solution. The solution, the problem is already there, and obviously you have to reduce vulnerability and try to reduce exposure as much as possible. But there is an existing problem, and you have to provide an answer to it. So we are always not denying that we have some capacities, and I said in my previous intervention that to try to control moral hazard, our main goal is to be relevant and provide an answer for people.
Yeah, insurance plays an important role in creating economic and societal resilience, and we have an interest to remain relevant. So that means we have an interest in helping to reduce the protection gap and an interest in keeping insurance premium affordable and reflect the investments that are being made. There are new ways of providing insurance, parametric insurance, cat bonds. They have their place. They are toolbox, as was said, specifically suitable for risks that are traditionally not insurable, so they can help reduce the protection gap for those risks that are difficult to assess, that are maybe dealing with moral hazard, as I mentioned, emergency intervention costs, infrastructure costs. Swiss Re is among the largest sponsors of cat bonds in the world.
And I think we'll end on a quick answer from Thomas.
Sure, well, it's great to know I've got a long-lost cousin. I'd like to, it'd be great to see that research, will be part of the answer, but I think more generally, I'll kind of stay on the parametric insurance. I guess for me at a high level, the ability for it to support ex ante, what can it do actually that to really support building the resilience ahead? But then second, and I probably need it to be full of thought, the extent to which, given the biophysical environment, the kind of core underpinning assumption and limits in parametric insurance, how viable are they 10, 20, 30 years down the line for a particular ecosystem or particular area, I think is a subject for deeper debate. but it's not necessarily apparent to me that the parametric insurance of 20 years ago, the model would necessarily be the one 20 years from now.
Okay, well, thank you very much to this excellent panel, and I really appreciate it. Apologies, Josefina, for running over slightly, and I think we'll hand over now to the next panel. Thank you.
Thank you, everybody, for... Yeah. Hello? Is it working? Yeah, so as we have a change of players, I'll just offer a few reflections. I mean, it's very interesting that we moving into the concrete sort of aspects as well of how can that lead to change in the way the water sector itself and what interventions are funded, because we heard from this the insurance company their willingness to engage as well in investing in prevention. I've had some personal experience actually working with the insurance industry. I think there's still a lot that can be done in this area. So we're now going to, and one other thing I would add as well is that the emphasis here has been a lot on Europe. The Europe Resilience Water Strategy is actually providing us with a framework to do this, because there's a lot of emphasis on living labs, on experimentation at the national, at the level of specific basins, etc. So these models are good to talk about in theory, but in practice they're actually quite difficult to put in place. So we really need to identify what works and do that. And this is, by the way, a sort of call and announcement for the next roundtable, which will focus on models for financing freshwater restoration, because we heard about the importance of investing in prevention, investing in nature-based solutions, but a key challenge is whether there are revenue streams and whether they are investable propositions. So this roundtable will take place in China, in Beijing, with the Ministry of Water Resources, where there's a lot of experience in investing in those models as well. So without further ado, I will soon hand over to Josefina, and I'd like to also acknowledge Josefina's critical role in getting all this together. And she's really the embodiment of somebody who's been working on the water side, and the Ministry of Agriculture and the Ministry of Environment, and has had the foresight for a very long time to think in terms of resilience and the importance of engaging with the financial sector. So I'd like to give her a special round of applause. In cinema, they have lifetime awards, so I think she deserves one by all means. And with that, I'll leave you to your panel. Thank you.
Sophie, okay, welcome. Welcome to this second session for today. And I'm Josefina Maestro. I'm from the University of Alcalá, formerly with the government of Spain, coordinating the economic analysis of the Water Framework Directive for a long time. Okay. And I think I want to think about this session as a session of moving to action. No? Yesterday we talked a lot about exposure, being aware of what the risks were, and I think now we're thinking about what is happening on the ground. How are we translating all these ideas about the material risks that we have been identifying? Are we really, is this making a difference? And I think we have a fantastic panel who's going to talk about how we are making a difference. For context setting, I would like to give you a little bit of a brief summary of a study that we did in the University of Alcalá, and we studied 5 banks in Spain and what they were doing. And basically, I'm going to give you the 5 messages or the key takeaways from the study itself. Basically, what we saw And I think it's normal in a country like this. I mean, it's not an accident that we are here with the Bank of Spain and talking about these things, is that the banking system, so the private banks, are really thinking about water. You know, so water is in the radar in different ways, but it is. Second, that exposure mapping is improving. The methodologies, how different banks are looking at how much their portfolios are exposed, is different. We are using different methodologies. People are doing different things. They are trying to manage the best they can, and we probably can hear from one of them here in Spain. But the fact is that things are going. I mean, the fact that they are using different methodologies is also calls already for a role of the regulator, you know, to try to see how we can really be comparable in the way we use these methodologies. So that's the second message. The third message is that most banks still remain more in a qualitative type of analysis of the exposure, and they are doing things with this information already. But I think still, you know, they are not really quite doing the bridge between the hydrological risk, if you want, and the credit risk, the risk for the financial system. Not all of them. There are very good examples of good practice, but still there is something there. Is that basically that there is an operational challenge now that we have found in the study. My colleague from the University of Alcalá, Carlos Mario Gómez, is there also, who did this study, is building the bridge between the hydrological indicators and the prudential parameters. So that's where we are now, and trying to make it explicit on how we are doing this bridge. So this is a little bit of context setting, because we are going to talk about that. We are going to talk about banks, what is their role. We are going to talk about investors, you know, how we do it. We are talking about disclosure, you know, what is the role of disclosure. And I think I want to recognize also the important role of CDP in all this, and I will ask a question to them as well later in the session. Okay, so we have panelists. Again, this has been recorded. My panelists will have 4 minutes each for the first question, and Kate here at the end, Kate Lamb, will be making a little bit of comments and also asking questions to the speakers. First of all, we have Tom Hegarty. He is the Associate Director for Transition Planning and Targets in the Task Force on Nature-Related Financial Disclosures, and he's been heavily involved in developing difficult methodologies to try to deal with this. We have also, from the bank's perspective, Antonio Blanco is the head of sustainability risks. He insisted that I said risk, not only sustainability, risks, from one of the main banks in Spain, which is the BBVA, who is also working worldwide. So, you know, really, anything they do, you know, it affects many countries. Then is Luc Susans. Luc, we had a little conversation before. You're doing very important work. Not everybody is, but I mean, he is the head of sustainability and transition strategy in Jefferies, no? And specializing in water investment risk and sustainable finance products for institutional investors. So you are working with big investors and seeing how they can deal with water risks. And last but not least, Kristen. Kristen James is the sustainability leader at Ceres and is an expert in mobilizing investor action on water risks. She leads the Value in Water Finance initiative, which brings together investors representing $18 trillion. My goodness, in assets. So everybody else also has good figures, eh? Don't worry, we will see them. So it's very impressive. You know, it's very impressive because we are not really only talking about what we need to do, the analysis we do, etc., but we are really talking about people who are actually trying to make a difference, and they're having an impact because they have a lot of people who have been really working on this, and also, you know, investors and investment decisions and sector decisions. So I'm going to start with you, Tom. I think we agreed that you were going to be the first one. Great. And Tom, your framework now has been adopted by 730 companies. So, and the numbers here is representing $9 trillion in market capitalization and $22 trillion in assets under management. No? You know, all these people are doing disclosure, and what is this disclosure telling us? No? What is really, you know, telling us about their level of risk, their awareness of risk? And the second part of my question is that what have you seen, because you've been working a lot in developing methodologies, what have you seen were the methodology gaps to really, you know, act on the disclosure information?
For sure. And so we're really pleased to see how much enthusiasm there has been in the market for the TNFD materials. As you're saying, the number of adopters of the materials is growing all the time. And in our status report last year, we were able to find over 500 first and second generation reports already out there in the market. So, you know, we're seeing disclosure growing really rapidly. And water is coming through in those disclosures. So I had a quick look through some of the financial institution reporting before this meeting. And so 2 examples that I thought were quite interesting. One is NBIM, so the Norges Bank Investment Management portfolio, and they did quite a detailed analysis of water in their tech holdings. So that's 27% of the portfolio is in the technology sector, and they found there was obviously a really strong dependence on water in that sector, but also impacts particularly through pollution. And they also identified that a lot of their holdings at the asset level were in water-stressed areas in Europe, the US, India, China, and Japan. And they actually divested from a few companies on the basis of poor water management as a result of that analysis. Also really interesting is the Banco de Bogotá. So they did some analysis of their holdings in the Magdalena Basin of Colombia, which represents about 80% of the Colombian economy. And so again, they were able to prioritize first their clients based on likely exposure to water-related issues. And they found particular potential risks in their palm oil sector from floods, but also in their energy holdings due to potential water stress. So some really interesting indicators of exposure coming through, but that is obviously then pointing to the challenges, which is going from that, as you were saying, sort of a qualitative exposure, potential risks, to trying to add that up to something that is a financially material effect at the portfolio level. And we were hearing yesterday about how financial institutions need to start thinking about correlations across different assets. So a drought isn't just going to be on one asset, but it'll be across a whole region. And how do you start to capture some of those correlations and start to add that up to a financial risk? The other challenge that every report that I read sort of raises is the challenge of identifying locations in portfolios. We are seeing a lot of progress on that. You know, financial institutions are identifying locations and doing analysis at the location level, often for a subset of the portfolio where they have some information. It's not always super precise, but it's enough to sort of start making some inferences about what risks might be. And Barclays is a really interesting example where they just focused in on the mining and energy sectors in their portfolio and did some really detailed analysis of those sectors. And that's obviously, those sectors are slightly easier because they are sectors where there are potential nature-related issues in the direct operations and they're very concentrated in particular locations. So, but nonetheless, they were able to demonstrate that there was quite a lot of insight that you could gather just in those sectors. So we're seeing lots of innovation coming through, progress is being made, but I think those are the 2 challenges that I would highlight at the moment that are particularly of interest.
So disclosure is working.
Yeah, well.
and talking about systems effects, you know, at least in countries like Spain, where we found that there is this compounding risks, you know, so that you have together heat waves, you have fires, you have droughts, you know, so it's much difficult to manage all that, even for, you know, insurers or other companies. Okay, I'm going to go on, Antonio, with you. Antonio, I think here in Spain, you know, really we can see that now the supervisory bodies, they're really, you know, increasing the expectations about what we need to do. And they are looking at everybody, you know, and I think you are looking at each other, in fact. So I think you, in a way, you are leading. The BBVA has a very important role in Spain. You are very good at, doing studies. You have a very strong department of economic analysis and studies. It's one of the most important think tanks in Spain in economic analysis. But at the same time, you have a very strong operational branch. So you are moving in between those two worlds, which is also very important. That helps you thinking that we think that you are leading these processes as well. So you are maybe ahead of the supervisory, expectations. So tell us a little bit about that. What are you doing in terms of things that maybe the supervisories are not asking for yet, and how you are maybe pricing or making decisions on your portfolio and the loans that people are asking you? So,
okay.
Yeah.
Well, thank you for having me here, and thank you to Bank of Spain for hosting this event that is very, very useful for us. Well, for BBVA, sustainability is a pillar of the current strategic cycle, and it was in the previous cycle. So because we strongly believe that sustainability offers great opportunities for our business, but at the same time, sustainability is a lever to achieve resilience in our business and in our clients' business. So sustainability is a risk management tool. This is something that we should keep in mind, that and I think it's necessary to remember this in these times where sustainability is somehow criticized in some jurisdictions. For us, this is a risk management tool. And in this sense, if we talk about water, water for us is fully or very embedded or interlinked with developing physical risk, climate risk measuring capabilities. We find that there are great synergies between managing water and water risk and measuring physical risk. Some time ago, we decided that we wanted to develop a fully in-house approach in measuring physical risk. I think that we have a different approach compared to most of the banks, but we are betting for developing our own capabilities because we find that we need to fully understand what we are measuring, and you cannot fully achieve this if you buy an external solution. So we are making a great effort to develop our own modeling, hazard by hazard, in a project that we call BBVA Adapta. And in this roadmap, we have prioritized the developing of the modeling of water-related hazards. So our priorities being droughts or floods, for instance, in this developing. And we are a user of the TNFD approach. We think that is very valuable. Help us to improve the way we identify the risk in our portfolio. But we use it in a way that we pay more attention to dependencies compared to impacts. I'm a risk guy, and I tend to pay more attention to the outside-in impact in our portfolio. I am not saying that impact is not important, and it can generate, of course, financial risks. But let's say that we have a 70-30 approach to this question. If you ask me where are we ahead, I would say some points. For instance, we are developing these internal capabilities in terms of measuring. For instance, for drought hazards, we are reaching some interesting outcomes. For instance, in the south of Spain, we are identifying preliminarily that we could see an increase of the drought indexes using, for instance, the CDD index in the south of Spain on average around 10% in the coming decade, using a central scenario. But this is only an average over the south of Spain. In some areas, the increase can be even worse. And we feel somehow comfortable with the results because we fully control the way we achieve them. We are working very hard in the geolocation databases. This is a pain point for all of the banks. We need to have better picture of where the assets are located to measure the risk. And this is a heavy lifting for all of us. I think this is a great effort. We are working in developing geospatial visualization capabilities, because you cannot understand this risk if you don't have a geospatial visualization. And we are providing these tools not only to the risk teams, but to the business teams, because this can be a very powerful support for our advisory activities with our clients. Yeah. So we have a sort of obsession in the sense that everything that we develop for risk management should have a business use. It's something that we always try to do. We are leveraging on artificial intelligence to obtain data and to better understand the outcomes of the calculations. And we are taking the results of the calculations to risk scores that we embed in our rating tools. So this is the way to achieve an impact in pricing, the rating of the clients. So in summary, I think that we are moving forward in reaching a more quantitative approach in processes like risk assessment, ICAP. For instance, we translate, for instance, these growth indexes that we project for our portfolio. We connect them with the IFRS 9 engine in the ICAP. Very importantly, we are moving forward in improving our risk admission guidelines for specific sectors. Okay. And this is I think that is very important. Christopher was mentioning data centers in the previous session. For instance, we have introduced specific admission guidelines for data centers where we consider the water efficiency of the assets that we finance, considering the cooling technology that they use, the type of water they use, the water stress in the location where they operate, and this is part of our decision making. So I think that is going to the practical use of water. No? For instance, we are developing satellite information use for our agricultural portfolio. We are measuring the crop conditions to project the potential yields that the clients can have. And this is a part of our risk management toolbox. And we are sharing this information with the clients. So these are some of the examples of the things that we do. And we are moving forward in having a value proposition for our clients in 3 pillars. Advisory.
Can we leave it for later? So you
okay. I wanted to talk about the value proposition because
we will do it
the business side wants me to mention this.
Okay. No, but thank you very much for the examples, because I think the examples help a lot. So because otherwise we're always talking about, we're analyzing, we are looking, and we are producing guidance, but what it really means for operations. So thank you very much for sharing that with us. Now I'm going to talk to my investors advisors here, and maybe I start with you, Kristen. Okay. Kristen, the Value and Water Finance Initiative is engaging 71 companies, no? Across different sectors. Maybe you can tell us which sectors you are working with. And you have some criteria that you are telling investors that they need to, they need to be aware of before they decide to help or to invest in a company, in a specific sector, no? And something very interesting apart from that is the same questions I was asking before to Tom, how is it changing, the actual behavior or the practice of the sectors themselves, these changes in investors' preferences, if you want.
Yeah, great. Well, happy to address all of that. But first off, thank you so much for inviting me to this wonderful event and the gracious hosts for these 2 days. Series may be newer to some in the audience, so let me start there of who we are. So we're an NGO based in the United States, and for the last 35 years, we've been working with institutional investors and companies, really mobilizing them around opportunities, solutions, but also the risks and challenges with a variety of sustainability issues, including our issue at hand today, water, but also nature and climate. And so, as Josefina alluded to, working with institutional investors on water risk is a priority for my team and has been for about a dozen years or so. And, over that time, we've definitely seen increasing interest and sort of uptake from institutional investors on the concept of water risk and action around water risk. And so back in 2022, we recognized that we really needed to take a page in the playbook from some of our climate work where investors were actively engaging with companies in their portfolio around climate risk and moving forward with mitigating that risk. And so with a number of partners, including the Dutch government, we launched the Valuing Water Finance Initiative and continue to grow and bring investors into the fold as, like we've heard today, more and more investors, it's hard to ignore the issues associated with water risk. And so right out of the gate, what we first order of business was we really needed to set what the North Star was for this initiative. On the climate side, maybe it's a bit more straightforward, but as we've heard, in the last 2 days, there's so many dimensions of water that we really need to think through, and all are arguably equally important. So we set out a group of what we call corporate expectations for valuing water. We co-developed them with the institutional investors, our advisors, other NGOs in the space. And they really hit the 6 key dimensions of water. So water use, water quality, which we've talked about, it hasn't been maybe discussed as much, but critically important. Yeah. Ecosystem protection, water access, and then also looking at the governance pieces, so looking internally at oversight within companies, board oversight, executive oversight, and then lastly, public policy. So really recognizing can't do it all within your own 4 walls, your own institution, but you really need to work with decision makers and policy makers on overall governance issues. So with those expectations in mind, Ceres has supported this group of institutional investors really in mobilizing them to work with these 71 companies in 4 focus sectors. So food, beverage, apparel, and high-tech sectors. And so we support investors as they're engaging with these companies, working on understanding the challenges, helping to identify solutions and overcome these risks. So you might be asking, well, what does she mean exactly by engaging with companies? So just to share sort of how that works in practice. So investors, and sometimes individual investors, sometimes teams of investors, are dialoguing with companies. So having deep granular conversations with companies in their portfolio, really better understanding, where do these material water risks lie? How can we help work together on solutions? So this can involve deep dialogue, this can involve communications, correspondence, this can involve shareholder rights deployment in the form of shareholder resolutions that go for votes. This can involve activation at annual general meetings. There are many different tools in the toolbox, and all of them have a place and a time, and certain investors feel more comfortable with different approaches. But we support bringing our water expertise to investors in these engagements. So you asked for examples, so just wanted to share out some of the recent movements we've seen as a result in part of these investor engagements with corporates. So one example to share is one of the world's largest fast food companies, stemming from a variety of engagements with investors committed to the first time to working in their supply chain on water and nature risks. So a big deal for one of the world's largest fast food companies. Recently, we had a large commodity provider that really was reflecting on their poor performance in some of the more governance areas, and so committed to doing more with linking executive incentives to water risk and tying in more board oversight. We recently had a major apparel company that decided to move forward a water policy that was aligned with these investor corporate expectations, recognizing that these were really, really critical. More and more examples I can provide. Data centers, we've seen a lot of movement around data centers and work to that end as well. So definitely a lot of good examples to share. I'll just close in mentioning, one of our big tools that we use to support investors is a benchmark where we evaluate where the corporates sit in regards to those corporate expectations that I just outlined. And there's 26 KPIs behind them, so a lot of data analysis using CDP data, other publicly available data. And we evaluate every 2 years sort of how are companies progressing. And so there is a good news story. So 48 of the 71 companies improved their scores with our benchmark that was released late last year. 83% have set water targets, either in their operations and their operations and supply chain. There's increasing board oversight. But on the negative side, water quality, which was mentioned before, is getting a lot less attention with only 41% of companies having targets. So there's a lot more nuggets of information, so I encourage you all to take a look at that benchmark. But to sum it up, I think, investor mobilization and engagement is really helping move the dial and mitigating on the ground this water risk. But progress is uneven and not fast enough. So a lot more needs to be done, but definitely a powerful lever.
Thank you, Kristen. You were lucky that you're not next door. I've stopped you before. Yeah. But anyway, very interesting the fact that you're not only looking at targets or benchmarks within the operations of a company itself, but you're looking at the supply chain. Very interesting about the context. So you're really, you're really looking at wider things, and I think it's a lesson for all of us as well on how to do that. So we'll be very interested to find out more. Luke, you have a very important role also. You are advising public equities, and you are in the interface, between water risks analysis and what institutional investors are doing, Mm-hmm. And what makes a difference for water investors? How do we have to, for these big investors, what do we have to do to really make a difference with them? Yeah.
Good question. Well, thank you for being here, and thank you for the question. Just to introduce Jefferies. Jefferies is an investment bank, and as Josefina was mentioning, my job is to advise the world's investment community, really, on sustainability factors, of which water is a big one, or has been for us for the last couple of years. Within that, I should say that, but my aim, of course, really is to help them maximize returns, right? That is, so my job is to help them make money, right? Which we think sustainability is integral to, right? So our clients are the likes of BlackRock and Amundi and AXA and the Norwegian Sovereign Wealth Fund and everyone really. Who cares about this is sort of an interesting question. Sorry, I shouldn't say it like that. But it varies dependent really. A big variable in that is your time frame, right? If you are an investor who has very short time frames and very short holding periods, specifically hedge funds, right? They may hold a stock for a day. Mm-hmm. This is not the topic for them, right? No. Whereas there is huge pools of capital, conversely, at the other end of the spectrum, where water is really, really vital to their investment process, right? And they're typically the ones that have long time horizons, long holding periods. They can be pension funds too on the asset owner side, and they're called long onlys, right? So the long onlys really, really care about this, right? The interesting thing about water as well is that unlike many sustainability factors today, particularly, at present, water has kind of it certainly has a cross-Atlantic buy-in, let's say. The US investor is as engaged on this as the European, which you can't say too often nowadays. And in APAC, this is really, really quite pressing as well. So there is quite international buy-in on this, as long as this sort of time frame element is sort of solved for, right? You asked in terms of how can we engage with these investors, which I may get into in the following question, because I do want to get into how you actually value a company, but we may get into that. I would echo Antonio's point, which is that more so today than ever before, at least when talking to public equities investors, I am only talking to them through the lens of dependencies now.
Okay.
The impact side of this, which had some momentum, let's say 3 to 5 years ago, at least in my conversations with public equities investors, where I think it's a little bit different in other asset classes, it's falling on deaf ears. And that is more a reflection of where sustainable investing more broadly is today, which is not in the most strong position. It's in a weaker position, certainly, than 5 years ago, which means that every conversation now has to be through the lens of financial materiality and delivering and maximizing returns, which, by the way, was always the exam question, right? We actually sort of, this industry strayed a little bit from that exam question 5 years ago. But anyway, and water firmly fits into that equation. The topics that are absolutely having traction with public equities investors today, PFAS, absolutely. The US is leading on that, not Europe. It is the US investor that is way more advanced on that. And even more interestingly within that, it isn't policy dependent, because under this administration, a lot of those policy drivers have been weakened, if not removed. The leading driver is litigation, right? Okay. And that's really fascinating, because a weakness, again, across sustainability factors quite broadly is often that it's so policy dependent. And we live in deeply politically uncertain and volatile times. And so that is a fundamental weakness to any argument with an investor. I would also say that the data centers part, which has already come up so many times today, which is astonishing, of course is front of mind for investors. However, again, I think as Antonio said as well, we are trying to have a more nuanced conversation with clients about that. Meaning, it isn't just data centers are big water guzzlers. They're not. There are many that are not. And there are many, indeed, as Antonio was saying, based on their cooling solutions and their efficiency and so on, make no water footprint whatsoever, right? And I can point to, if you look at one of the hyperscalers, I'm not allowed to name names, one of the hyperscalers' activities in Sines in Portugal, it is using, and it's 1.2 gigawatts of data centers, by the way, so 200 megawatts, using solely seawater. Desalination. Because water scarcity is a huge issue in that location. So again, it's all about credibility, right? And a lot of, again, our sort of ESG sustainability community have conducted analysis that has partially discredited the industry a little bit. And we are trying to have a slightly more nuanced conversation.
Luke, we had a little discussion before, and I asked you, because you're advising all these investors, and what is the impact of your advice on their decision making? Can you say something about that?
I said I have no idea, because they're not allowed to. Well, maybe they are allowed to tell me, but they never do, right? They may come out of a 60-minute meeting with me and say that was the worst 60 minutes I've ever spent, Or they may leave that meeting and completely change their portfolio, So I don't know. But what I do know is that we talk to everyone, and so probability-wise, we may have some impact.
And I have a second question. That's very important answer, but anyway, you would argue that this idea of the dependencies versus impact, I mean, the impact is more related to reputational issues, you think? and maybe now dependency is more like, returns, basically.
It's definitely true that that's the counter-argument, of course, and some slightly more advanced, slightly more ethical European investors will say that to me, saying that there is indirectly a financially material risk there. It just goes through the vector of reputational risk going back to financial risk. That's one additional layer of complexity, which is never ideal. And two, we at least hold the view that of the risks that we could talk about, reputational risk is pretty low in that hierarchy. The market often doesn't care. So, so that's unfortunate.
Okay. Thank you, Luke. We're going to go to a second question, and this is a bit shorter answer, I hope. Tom, the second question is really about what we need and how are we moving forward. So it's a little bit on the question of the roadmap, what we have to do next. So we want our panelists to try to help us think about, our roadmap. And Tom, really all this disclosure is voluntary, and is it going to be fast enough? Is it going to be dealing with the water, in a way, risks fast enough? What do we need? What do we need from regulators? What do we need from, I don't know, financial supervision? In order to move on from something which is voluntary to something that is more widely applied?
I think it's not just about disclosure, it's also about doing that internal assessment, right? So I think the assessment is the bit that, and the internal management, so understanding what are the dependencies for this business, what are the impacts they're having that expose them to sort of liability risks in the future. And so I think the first thing I'd say is getting that assessment to be much more widespread and embedded. So I've talked about some leaders that are already, we've heard from some leaders that are already doing like really interesting analysis, but there's a long tail of companies that aren't thinking about these issues at all, and even getting them to just do an initial basic screening with a tool like Encore or WWF risk filters, these freely available tools that anyone can just pick up. That would be like a really good start, just getting companies to recognize, oh, we do have a potential exposure to something here. So I think that's the first step, is mainstreaming even the basic practices. And then I think for the sort of companies that, or the financial institutions that have done that, is sort of starting to edge forward the system by asking better questions of their clients and of their investees, and setting out their expectations. So all the stuff that Kirsten was talking about, like what are your expectations? What information do you want from your investees about their nature-related issues, their locations, so that you can then understand your own risk portfolio, the risk in your own portfolio. And the data providers can also understand what you need and can start to also reinforce that and develop some of the solutions. So I think there's sort of, it's very easy to sort of just say, oh, there's no data, but as part of it is participating in a collective effort to edge forward that system and make clear what is needed so that everyone can start to provide that. And finally, I think we need to start thinking more about opportunities as well. So we've talked a lot over the past few sessions about all the risks we're facing with nature. There are also opportunities here. Providing finance for better water efficiency to reduce demand and therefore mitigate some of the risks we're facing. Providing finance for the development of those technologies. We've heard about data centers and how there's like lots of different technologies out there, and how you can sort of shift some of the dependencies away from the more risky end of things. But then understanding also what are the knock-on effects of that. So you can go for desalination, but then you have a big new energy dependency and a big new pollution impact. And so how do we understand those sort of complexities and work that way forward whilst sort of thinking through the opportunities? And then you asked about like governance and regulation. So TNFD is as I said, a voluntary initiative, but we are seeing progress. Obviously, the European regulations are back out for consultation again, so we need to look in detail about what's happening there. The ISSB is also doing work very focused on the financial materiality piece and trying to understand exactly what information investors actually need and I think investors' input into that process will be really valuable to, when the consultation comes out, to make sure that what they put out is meeting that need. So I think there's stuff happening, but I'd really put emphasis on getting that assessment process really embedded.
Yeah, it's a moving architecture, no?
Yeah.
Thank you, Antonio. So now is your time you can go on saying, making your contribution. But what I wanted to say is that, I mean, what does your bank needs from, regulators, supervisors? You are already ahead, no? I mean, I think maybe that's something important. But what is really important is not to think about these regulations that become a compliance exercise, no? Because then, what's the point? At the end of the day, what we want is what you are really doing, is to make sure that this has an impact on operations, no? So.
Well, to start with a positive tone, I think that it's very, very valuable. Some initiatives from the supervisor, from the ECB, in the sense that they are collecting the best practices in the industry, and they are disseminating this. And I think this is very, very, very useful for us. This provides us very, very good insights. This helps us to move forward and to move fast. In parallel with this, we have a very valuable initiative that is hosted by the EBF, that is the CESG Roundtable, where main practitioners in the industry in Europe share our practices, we share our ideas, and we explore how to do things. We meet regularly in different working groups, and every 3 months we have a roundtable. We have a meeting where the ECB participates and provides feedback on the discussions that we have. So this is extremely useful for us. But if I had to say, what do we need? I think we need climate, natural capital and water-related scenarios that are robust enough, and that are usable for our practical use, for our exercises. And I think that a strong collaboration between supervisors and international institutions is needed. This is more challenging than having climate scenarios. As you know, this is much more complex or multi-dimensional. So this is an effort that is worth trying to make. And of course, we have the challenge of data. I think that, we have voluntary frameworks like CDP that are very useful, but we still have data gaps, for instance, in the middle market segment. And at the same time, we have these simplification efforts in the disclosure in Europe that I think were very, very necessary. But we need to strike a balance between this simplification effort and the pressure that the banks have to increase our capabilities for risk management and for disclosure. So I think that there is margin to improve the balance between the pressure that we feel and the data availability that we have in the end. Because if not, we are going to make decisions based on proxies. And I don't feel comfortable making decisions in the real life based on proxies. And for sure, this creates a lot of friction with the business teams. I'm talking about decisions at client level. Finally, I would like to stress the massive effort that embedding or onboarding capabilities like geolocation of assets, visualization tools, modeling hazards, etc. This means a huge effort for the banks, for the banking sector. This is new stuff for us. So every help that we can have from the institutions is welcome. And for instance, events like this are really, really helpful. And other examples, like for instance, the ECB has organized a workshop on physical risk for banks now in June. There is another workshop from Copernicus in June. All these initiatives are really, really necessary and are really welcome for us because we cannot do this alone and we need to share best practices and to build this along together as an industry.
I like your answer because I think a lot of what has been transpiring, and we have talked with the Bank of Spain as well, is that we don't want to have another reporting obligation to banks that, it really adds on bureaucracy, if you want. You really want things which are useful and for the bank operations, So those kind of things we are saying, basically, is the kind of role that you would expect from the supervisor to help, in making this type of operations work.
Yeah, but for instance, Pillar 3 requirements keep growing. This is an example. No? So we need to find this balance.
Yeah. Okay, Antonio, thank you. So, Kirsten, what you are doing is great. How can we make it at the scale? How can we really generalize it? What are your ideas? What tactics do we need to really make things happen in a broader level, especially in places like the US? I mean, we were discussing before, and I think also in the conference, in the Water Intelligence Conference, that in the US it's not easy for the NGOs now.
Yeah, we are definitely facing some headwinds, but I think there's some positive trends. I think for me, just seeing the interest from institutional investors in the issue of water risk and wanting to engage with us and through our initiatives is very promising. We have the trend in the right direction. Of course, we're working with 110 institutional investors representing 18 trillion in assets under management. We need to double that. We need, more and more folks to come to the table, but we have seen a lot of promise. We've seen a lot of interest in investors getting really curious about water risks within the high-tech sector that has been discussed. So, trying to really, seize upon that interest and support them. So I think there's some good trends to see, but we need to work to elevate this on agendas. And so I think similar to Antonio's comment, we need to work together. We're all the enlightened here in this group, and we need to work together to elevate the issue to capacity build. I think, water can be a scary issue for some, many dimensions, complexities. So how can all of us help to, really set the expectations, unpack the many complexities, get out ahead of, where are the material risks within the value chain? For so long, we've had corporates, just focusing on, their operations where, the risk really typically doesn't lie there. So really sort of unpacking those complexities, get ahead of emerging risks like, the data center issue, and really helping investors understand those issues and be able to then engage. I think to the previous point, there's a lot of complexities there, but, there's also more to the story when you start to unpack things like the cumulative risks of, many data centers going into the same basin and drawing from, energy supplies that also have a water footprint. So helping unpack these complexities, I think, are really important. On the policy and regulation side, Ceres has long supported our colleagues, on mandatory disclosure. Obviously, that's stalled somewhat in the United States. We've had some success in California, the fourth largest economy, so there still are some bright spots. I think, that's definitely an area where we'll continue to focus on. Unfortunately, right now in the U.S., we are playing a bit of a defense role to uphold, the fiduciary duty of financial institutions with various policies that are being proposed a lot at the state level. You don't often hear of what's going on within the states. Currently, we're tracking 45 pieces of legislation in various states as sort of our high priority. That's not even all of the legislation that's out there that, while, yes, it's special interests that are focused more on the climate side, so water is somewhat buffered, water can get swept into that. So definitely playing a defensive role there, but hopefully we can hold the line and just together with all of you in the room, bring more folks to the table on these critical issues.
Thank you, Kristen. Luke, you know, something similar, no? But I think we need to talk differently, you know, to investors, no? To try to take this to scale, to really, you know, understand, no? Make investors understand, you know, the materiality of water-related risks to them. So what would you propose?
I mean, that's exactly it. The way to engage investors is really, really simple, right? You use their language and you talk in their terms, right? Finance isn't going to come to us. We've got to go to it, right? The scientific community needs to do that. The NGO community needs to do that. Each other different stakeholder group needs to skill up if they're trying to engage investors on the language and the terms that matter to them, right? And then, point two, you present a different view, right? You challenge their assumptions and you present a different view. Now, in equities, funnily enough, that's really, really easy, fortunately, right? It's really easy. What do investors do? Investors are trying to value a share of a company, right? To do that, it's very, very simple. You forecast that company's cash flows to perpetuity, and then you discount them back to their present value. And then if you're an investor and your estimated present value, if it's above the current price of shares, you buy some, and if it's below, you sell some. You know, so it's really, really simple. And when you think about that, even just that basic premise gives you an idea of some of the levers that you can pull, right? The discount rate. The discount rate is the cost of capital. Well, if you think one company is going to have a higher cost of capital than its peers because it operates in an area of water stress and water scarcity, and it has dependency on water, that's going to be, you need to integrate that into your model, you need to reflect that in your outcome, and then you go to investors going, that's weird, I've got a different conclusion than you have, right? So you can play with the discount rate and the cost of capital, and you get all sorts of fun results, or you can try and adjust your assumptions on future cash flows. What about higher costs for a company in the future? What if it's operating in an area of higher water pricing? Or if it's operating in an area of water stress, then it's having to invest more capex up front. All of this increases the cost of goods sold, which reduces your future cash flows. Or the top line may come down, your revenues, right? So simple. And you just say, look, I've made a different assumption than you because of X, Y, and Z. And as a result, I think you should potentially reconsider your allocation. So we have to talk in the language that matters, which is cost of capital, revenues at risk, cost of goods sold, capex inflation. You do that, you'll get an audience for what you want to do.
Thank you. It sounds simple, but...
It is simple. It is simple.
But it isn't. I think, you know, I'd like to, before I hand on to you, if you don't mind, I think I'd like to ask Joe from CDP. Can we have a microphone here? These people, I think they're here, no? Here. Joe, we've been talking a lot about disclosure, and there is a number of financial institutions in your database, no? You know, and we are asking all, you know, the panelists, you know, whether it has made a difference, this disclosure. Can you tell us a little bit about that?
Well, that's a big question. Fascinating conversation this morning. Thank you. Yeah, a few quick reflections from the data. So as most of you will know, CDP collects corporate data, real economy data, and has done for more than 15 years now, specifically for water. But we also, since 2022, thanks to the great efforts of Kate and her team at that time, have been collecting data from financial institutions directly. So in other words, surveying FIs and asking, what are you doing about water risk? What's your level of awareness? How do you even assess your impacts, your water risk exposure? So a few quick highlights to pull out on that from our 2025 data set that are relevant for this conversation. In 2025, out of around about 300 financial institutions who answered that part of the survey, 54% say that they assess their portfolio's exposure to water-related risks and or opportunities. 55% consider water-related information about clients or investees as part of their due diligence and risk assessment processes. But then to Luke's point about impact not necessarily cutting through in the way that it used to a few years ago, only 29% say that they measured the impact of their portfolio on water, that double materiality lens. The majority of those are banking institutions. So I think there's a couple of different ways we can interpret this. If you are a glass half full kind of person, you can say, well, these are major players. We're talking about 300, many of which are the largest institutional investors in the world. We've got many trillions of dollars of assets under management here. So, arguably there is a critical mass of awareness. The flip side to that is just looking at the numbers the other way. Almost half of this sample of FIs don't assess their portfolio exposure to water. Almost half don't consider water-related information as part of their due diligence processes, and less than a third are taking that double materiality lens to the topic. So depending on your perspective, there are different stories to tell here. Final point, I think all of this underlines the absolute imperative of central bank and supervisory engagement on this topic.
Thank you. Thank you. That was a good conclusion. I like to handle, I have a very easy job in this panel, really, because I have Kate Lamb, who is going to be our discussion, so I don't have to make summaries or whatever. Kate is the freshwater lead at UNEP FI and leads the organization's engagement with banks, insurers, and investors, and she's playing a key role, really, Kate, in bringing us together and keeping us going in all this process. So there's a lot of things happening for us to be all here, no? Kate, I know you have, good questions for our panelists and good reflections. Maybe we can bring in something that I think we haven't talked about, but I would like to also bring it in, which is the question of water pricing. What effects it has on investors' decisions, on banking decisions, whether that will help with the financial materiality of water-related risk. But that's my question, but maybe, we can embed it in your...
How much time do we have? I mean, we need an entire day on water
no,
pricing.
No, we have a little time. I'll tell you why. Because we have about 15 minutes.
Fabulous, fabulous. Well, then we'll make the most of those 15 minutes and eke every little piece of water out of it. Because... and thank you, panelists. It was a really excellent discussion. And I think in reflecting, before we move on to the pricing question, we heard some fantastic examples of great leading practice, right? Kirsten, Tom, Joe, Miriam, and the WWF team that are in the room, the OECD team, myself included, we're possibly some of the hardest working people in the room from a water perspective. We have been pushing water uphill with financial institutions for easily 20 years now. And it's insanely gratifying to have you all here and to have different faces in the room to speak to. But at the moment, what we've heard is all of the interventions, even undertaking some fantastic research with Luke and the team on looking at the way in which corporate valuation might be skewed in the wrong direction because of these dependencies on water, all remains in the voluntary basis. Antonio is a fantastic leader. BBVA have done fantastic work, not only on his side of the house, but also on the other side of the house, where they have issued the first ever water footprint loan, which ties the rate of interest for the Iberdrola, which was the corporation that benefited from this, not only to achieving a CDP A score from a water perspective,
Thanks
but
for
also
mentioning, because I didn't have the time.
No, of course, I'm going to do this for you because it's absolutely fantastic. But also to achieving a 40% reduction in freshwater withdrawals. And if the company achieves that, it achieves a lower rate of interest. Like that, for me, is the perfect market intervention. But we've only seen one of them. And again, it was a voluntary mechanism. BBVA did it because there was a market demand from the client. There was a point of differentiation, so it could beat its customers. It could beat its competitors, which you did very beautifully. Well done. But we also want everybody to lean in and create these types of products. There's a saying in the water community that a rising tide lifts all boats. I've heard Kirsten say this multiple times. And we know that as much of the leadership on display here, whether it's the institutional investors that Kirsten is engaging, whether it's the 700 companies that are disclosing, the 10,000 companies that are disclosing on water to CDP, they will all still be exposed to risk. And the banks and insurers and investors that are financing these institutions will also be exposed to risk. And fundamentally, the communities that are dependent on this resource for their livelihoods and for their way of being will be exposed to risk, because there's a whole heap of other market participants that either don't care, that should, or that they do care, but they don't really know what to do. And they're designing, constantly reinventing the wheel. So at UNEP-FI, we've got almost 600 banks and insurers. I've been on webinars with them for the last year with around maybe at least 1,000 individuals from a range of different banks all across the world, whether that's banks in Mongolia, insurers in Japan, banks in and investors in the US. They're all making it up as they go along at the moment. They're all reinventing the wheel from a risk assessment perspective. And in doing so, wasting valuable time and energy and coming up with different conclusions, which in some respect is, again, a market advantage. It's a competitive advantage. If you get that assessment right, then you're going to win. You're going to beat your clients, which is ultimately lesson number one in the market. But arguably, you're only going to get it right for so long, because it is possible to be a clean fish in a dirty pond. And as a result, it's great to be doing all the good things if you're a single institution, working with your portfolio. But if everybody else around you is not doing the right thing, you will still be exposed to risk. You will still have farmers allowing their PFAS to enter into the water, and you will still be dealing with this risk. So the question ultimately, I think, that remains in this room, and that one that we should be exploring, and rather than asking it to the panel, I think I'd love it to ask it to the room and give you guys the opportunity to ask the panel the questions, because you've heard enough from us already, and you're all looking a bit tired and needing a bit of a boost, is how quickly can we move? You know, is it okay that we remain in this voluntary space because of the good examples that we're seeing? And if it isn't, what needs to change? And how do we specifically take that forward in tangible mechanisms that mean that it's not only BBVA doing this, but it's the mid-size bank round the corner that's similarly compelled to act on this topic? So thank you, Josefina, for that, for a moment to share my views on this.
I love listening to you. Anyway, so maybe we can ask.
Please, I think so.
Any questions for our panelists?
Good morning. Thank you very much for these 2 days of conversation. My name is Paula Henry from the Spanish Climate Change Office. So here we have heard a lot about climate risk management and also about water risk management. From the Climate Change Office, within the adaptation team, what we are watching with some concern is how difficult it is for companies to understand what is the climate physical risk that they need to report, that they need to focus on. And I think water provides a very good example of when thinking of climate risk management, what is the differences between mitigation and adaptation. So where can we draw this line to establish a minimum common denominator on what needs to be considered as good adaptation, good enough adaptation, included to not jeopardize those efforts that are made by companies in mitigation and which are reported and considered as climate risk management.
Thank you. I'm going to take a few more questions. Yeah.
My question is for Antonio. My name is Maria Nieto. I'm now with the LSC, with CETEX, and formerly Banco de España. My question to you, I think, is very interesting, and I put it with what Irene said yesterday in the session, is your focus on dependencies versus risk. I found that extremely interesting. And I was wondering, being just somebody external to a bank or having ever done anything related to risk, whether this is the stage on your analysis, to the extent that once you have identified all the dependencies, your focus seemed to me, from this point of view, that would be focused on the risk. Whether this reasoning is correct or not, that's my question.
Thank you. I think we'll take one more. Anybody? Yeah. Caroline. You introduce yourself?
Yeah, hello, thank you. Carolyn from WWF. I have a question, and maybe it's again related to the room, not necessarily to, or also to the panel. I'm happy to hear the inputs there. And I just wanted to say I really appreciated the very frank inputs from you, Luke. Thank you for that. And I think that's kind of what triggered my question now, and also what Kate was mentioning, as well as what we heard from Joe about kind of how impact assessments or considerations are not really kind of part of the business, like don't make sense from a business point of view at this stage for most. And I'm wondering how this is perceived as well from the supervisory community if we come to a state where financial institutions don't assess their impacts, but collectively that is actually causing a risk buildup in the system, which brought us actually why we're in the room here today to begin with. And so I'm curious from this kind of endogenous risk perspective that we also heard in the presentations yesterday on the conceptual framework from the NGFS, how this all fits together basically, and how we can kind of overcome that issue where we just leave it up to voluntary kind of things that make sense from a business point of view, but actually from a systemic point of view can be quite detrimental.
Maybe Caroline, that question goes a little bit beyond, the panel itself, but maybe we can also discuss it. Okay, so I come back to the panel to see whether you have any comments on that. I think there is these questions on dependencies versus impacts, which I think both of you can say something about that. And I think there is also a question from the Office of Climate Change of Spain, which, by the way, they have done a very interesting analysis on the systemic risk of water with all the other risks related to climate change, and is the one that has more links to any other risks. So I think in that way, that's important. But maybe you can also talk about, what I understood from your question is really what is the sector implications, how the sectors are reporting on mitigation, and how does that affect also adaptation. But I don't know whether you want to make some comments on that. Kristen, you want to start?
Sure. Well, I can maybe touch on the dependency versus impact piece. I mean, I think, I think when you maybe hone in on various sectors, it's maybe more visible sort of where the impacts are creating a risk. And so sort of linking those pieces. And just to give an example, when we look at our benchmark data, the apparel sector is really looking at impacts of water quality, regulations, and as a result is doing a lot more to mitigate those pieces. So another example would be again back to high tech and data centers. We are seeing I think throughout the globe, but it's definitely in my face in the US, all of the data center discussions and social license to operate discussions that are canceling projects. Some really staggering figures came out in Q1 of all of the projects that have been stalled and permits delayed. So I think, sometimes diving a little deeper into the sector, I think can help us look at sort of that impact side a little bit more and really sort of start to pencil out more of where there really are risks associated with those impacts.
Thank you. We have 4 minutes, so
I didn't,
1 minute.
I didn't want to mean that we don't pay attention to impacts. There is, you have dependencies and impacts, and our approach is that we identify both in our portfolio at sector, at subsector level, and even at activity level in a very granular way. But when we want to build, for instance, a natural capital score, we put some more weight in dependencies than in impacts, but we consider both. The question is that if you want to measure impact, sometimes data is more challenging than dependencies. In dependencies, if you have the location of the client and you have the stress, the water stress of the area, etc., you can build some kind of dependency score. But impact is difficult and depends, in many cases, on disclosure. But we consider both. And a good example is data centers. We are talking a lot about data centers. And connected with what Luke was saying before. I had the chance to be in the CERA Week in Houston some weeks ago, and this is a place where all the energy sector discusses all this topic, and data centers impact was a hot topic. And there was a lot of concern about how to deal with the impact of data centers and the relationship with local communities. Because if you don't manage this properly, this can be a source of litigation that you were mentioning. And investors are concerned about this. So, of course, we pay attention to this. And this is part of our admission guidelines. How do you manage in the case of data centers, how do you manage your impact? How do you deal with local communities? How do you deal with this growing opposition that is we are seeing, for instance, in the US? So we consider both dimensions, of course.
We have 1 minute, so yes.
Can I just quickly make a couple of comments? Just on the first point on adaptation and climate. We did sort of 3 months' work on flood risk in Europe, trying to get investors really engaged on that topic. And I think it sits at the intersection of your adaptation work and obviously water. And we failed massively, right? Investors fed back with them, you know, kind of a shrug, right? But maybe I'm just going to provide the feedback that we received, which might be able to help you in your own sort of work, right? So some of the pushbacks we received were things like, well, for issues like flood risk, the past is actually no indicator of the future. Because where there have been floods in the past, often resilience has been built, right? And therefore, it's actually no read across whatsoever, so it makes it even more difficult to forecast, right? The point was also then when we were sort of saying, you know, oh, well, a flood risk event in this location is going from being a 1 in 20-year event to a 1 in 10-year event. And they go, well, when in those 1 10 years is that going to happen? Because I only hold a stock for 5. And then similarly it goes on, which is, well, okay, even if an issue occurs and a company does take a financial hit, surely it invests capex and solves the problem and therefore has higher resilience again going forward. So it's an acute risk, not a chronic one. And these are all really good points, by the way. So we were like, great point. And then just finally on the systemic risk point, just because it is where so much of this industry is going in the sustainable finance world. It's being spoken about a lot more. I'm not yet fully sure what I think about that yet, but what I would say is that, again, with public equities investors, your conclusions will be relevant at a sector level, because you will be able to say this sector is impacted in this way, this sector is impacted in this way, but because it's a systemic risk, you ultimately won't be able to derive idiosyncratic conclusions. This company is more at risk than this company. And therefore, this conversation around systemic risk, which obviously is exactly right, and planetary boundaries, don't get me wrong, I'm just speaking completely neutrally. And again, it comes to that point where then if you don't get to company-specific idiosyncratic risk, then the conversation is going to be somewhat limited.
Thank you.
Sorry, so I think it's quite related to this disclosure point, right? So if we're just looking at, if companies are just disclosing with a financial materiality lens about their own particular operations, so I agree with Luke that actually it can be quite simple for a financial institution looking at equities, you know, as Luke was describing, and really it's about familiarizing themselves with the topic a bit more and understanding these are the kind of assumptions and scenarios you can build in. But that's sort of, sorry, I'm wrapping up a bit.
I know, we are beyond our time, 2 minutes, so.
But I think, just my point is that it comes up to the limit of what's possible with disclosure, I think, and I think there's this gap between what's financially material for an individual company versus the information investors actually need in order to be able to understand the risks in their portfolios. And this gap is something that I think we need to explore a bit more.
Thank you. I'm sorry for rushing you. Beautiful. Thank you very much. I think we can give a round of applause to this fantastic panel. Thank you.
Sophie?
Hello, hello. Thanks for your attention. Hello. Excuse me. So because we have people online, we need to keep to time. So we'd be grateful if you could take just 15 minutes, and we can come back at 12 o'clock for the session 7, which is really where we're very much looking forward to hearing from you as well. Thank you.